On macro all the time. Ben, you heard the conversation on the desk. I wonder what you think about that overall big picture for the global economy. Is it supportive, and why do you think we're due for a pullback?
Yeah, I would be with more the others about this pullback. There's several signs, I think, for the short term. If you look at the RSI indicator, the S&P, the Nasdaq, and the Russell are all overbought on that indicator, but they mostly are overbought as much as they were overbought during the 2020-21, let's say bubble moment, and they're even as overbought for a longer period of time. I think it's almost like a month and a half now, so that's quite stretched. And if you then take the story to interest rates that we're just discussing, the bond market, in my calculations, probably priced more like 75 basis points of excess rate cuts. It almost looks like the bond market is priced for this perfect scenario of a second Fed pivot to faster, deeper cuts. I think that's the tension as we're getting into the new year. We have a packed agenda of big data. The economy shows some sign of acceleration. GDP now went from 1.25% to 2.25% of the last sort of 4 weeks. So there's some sort of acceleration going on. So I think interest rates are primed to pick up a little bit from here and then take back that overbought condition on the equity indices.
What part of the market is going to be the most vulnerable to that pullback? Is it going to be the stocks led to the upside? And if that's the case, then which stocks do you put on the list in case it's just a dip to buy?
So I found notable, Dom, that if you look at small caps, right, and you plot that against the junk market, take the J&K ETF against the Russell 2000 ETF. Since the end of October, it's just exactly straight line up, more like a lockstep. So as Julie says too, and Steve says, like these sectors are highly interest rate sensitive. I would almost call them like they're sensitive to the relief of interest rates. So if you get a bit of a backup in rates, I would think that there's where you see the first real correction. It seems like kind of a bit of a frothy moment there in each market. On the other hand, the big cap, the mega cap are probably going to stay in a good trend here because that's really about earnings. And I don't see these earnings being downgraded so quickly just because we're getting a short-term correction in rates.
So Ben, when you look at overbought, obviously overbought, a stock can be overbought, the market can be overbought, and it can work that off. But as far as that second pivot, I think the second pivot's going to come from inflation falling a lot quicker. Have you calculated that? Do you think that could fall in a precipitous fashion and leave Powell sort of trying to catch up?
I think it's a good point, Steve, in the sense that if you look at the PC deflator that came out the other day, in that basket there's deflation now, and there's about, what I calculate, about 10-15% of the index is in a deflation for the last sort of 6 months. A lot of these categories are influenced by supply, so it's maybe to an extent not so surprising, but it's telling. So say that deflation starts spreading further in the core PC deflator, then you get the scenario we saw back in 2022. The Fed's, again, behind the curve, ironically, have to come forward with more rate cuts faster. But I think at this moment where we are right now, we're not yet in that really accelerated down move in inflation yet. So I think it probably is going to be something more of the second half of these rate cuts starting. Again, idea that the economy stays on its feet and inflation just continues to moderate, giving the Fed room for some rate cuts.
So Ben, in terms of gold, obviously something I know you like quite a bit. Here we are 2 years later from the peak in the S&P. S&P is basically unchanged, and yet gold's up some 14%, one of the best assets over that 2-year period. Obviously you're sanguine on gold, you think gold's going higher this year. If you had to pick gold versus the S&P for the next 12 months, which do you prefer?
Gold is interesting, Carter, because it is this asset that can outperform in an environment where there's uncertainty, but it can also outperform an environment where you have easing conditions. And that's actually what's happening currently. The last sort of month, as we talked about in the previous show, gold has had a reasonable performance here in December. It actually broke out to the record high when we talked about it. I think this has more scope. I mean, if 2024 is a year where a lot of people do expect a fair bit of uncertainty, it probably will fuel gold. On the other hand, it's this rate cut story, as we talked with Steve about, if you get accelerated rate cuts, then gold will really go a lot higher. So to me, gold is a really interesting asset for 2024 as a diversification portfolio. I think it could add in that sense value.
Makes a lot of sense.
Hi Ben, Bonawin here. Happy holidays to you. So, a quick question. In terms of the dollar, it seems like it's made pretty much a full round trip over the past year or so. Can you kind of give us a bit of insight into what you're looking in terms of dollar strength or weakness, and then what those implications are for possible offshore investing opportunities?
Yeah, the dollar has just made this move now towards closer to 100 on the dollar index. And if you look at that move, you know, it's really the peripheral currencies like Norwegian krona and Kiwi and those type of currencies that have really been driving the move. But when I really think about the dollar getting weaker from here, you have to pay attention to the Japanese yen. Now we're getting signals from the BOJ governor Ueda that they are ready to make a move on rates sometime in the next quarter. And Japan is being this story of really good stock market, but with a really weak currency. So the currency has a lot of scope to rally, and I think that will be a big push for the dollar to get weaker. In addition, that you do have the story in Europe, as in there's some mild recession happening in certain countries like Germany, but yet the
Wow, I
ECB is
didn't know
not so
that.
keen to pull the trigger on these rate cuts faster than the Fed does. So the euro will continue to have a bit of a lift here. So to me, when the dollar index gets below 100, you know, the history of that shows that commodity prices in emerging markets start to really lift up. So I think the dollar index has more scope to go down. And I think really if you look at then emerging markets, to sum it up, is that emerging market bonds really look attractive in that sense. You know, they have undervalued currencies and higher rates than here in the US.
All right, Ben, before we let you go, what's the key part of the stock market you're going to watch in 2024? What's the big storyline you're keen
Earnings.
on?
So it's definitely the cyclical part of the market, Dom, because if you think about the soft landing of the economy, and there's so much of that now priced in that sector. You think of small caps, you think of consumer staples and consumer discretionary. I think this is where the big story will be. If the soft landing doesn't pan out, that part of the market will really underperform.
All right, let's end it right there. Ben Emmons, thank you very much, and kind of send it around here. And Happy New Year, Ben, for you. All right, let's trade this, guys. Carter, we heard the big